Today's Friday, January 17, 2020. Today's session title is Can the Markets Grind Higher Continue? And this is your 2-minute drill. Hey, I'm Jonathan Gurney, Portfolio Manager at Gurney Financial. The purpose of these videos is to educate and keep clients aware of what is happening in the stock market. Our goal is to close the gap in communication between clients and the actual person managing their assets. We use fundamentals primarily and technicals as part of our analysis. We hope the charts and education help clients and viewers alike. Friendly reminder, this video is not to be taken as financial advice. Should you have questions, feel free to reach out to us through email or social media comment section. We just released a new website at gurneyfinancial.com. Check it out. Okay, we're going to hit it. The market is actually not closed quite yet, so results will be a little bit off, but we wanted to get this out because this weekend is going to be a little busy with some research and so on. So, wow, was this ever an impressive week and a continual rally that we were seeing. Again, you're seeing a classic 1.5-year consolidation period leading to good things. Technicals and fundamentals are on the same bullish side. You have a Fed that is keeping rates historically low, markets struggle, or we have recessions when companies don't have access to money. This is certainly not the situation we are seeing. The velocity of the move is a little peaky, truthfully. It doesn't mean I don't think we're going to go high midterm, but based on a lot of metrics, and I'll be showing these to you today, I think we need a little bit of a cool off. It could be 2-3%. It could be 10%. While I like what I see midterm, I am concerned that we've gotten a little bit ahead of the true fundamentals. Banks this week have reported relatively okay numbers in general, while transports have been truthfully a bit iffy. So JP Hunt reported pretty ugly. Overall, we did come away with a very impressive Phase 1 trade deal. If you think that this is going to be 2017 where there is virtually no volatility, this is probably not a wise assumption. So at times like this, you got to be smart and know the behavioral science behind all of this. Realistically, why do you think we have all these different phases of the deals? We want a little bit from each. So we're going to keep pressing, and that's probably going to lead to some volatility. Friendly reminder that do not bring politics into your general view of the market. Sure, some sectors are naturally likely to do better under certain presidencies, but if you're the opposite party, do not necessarily assume that all will break down. Same thing with Republicans during President Obama's administration. A lot of those investors were always concerned, and that was some of the least volatility we've ever seen throughout history. So keep politics out of it. The market does not care about your political affiliation. It is an amateur move. Understand the behavioral science behind this. It's not being me. It's not me being mean. It's just being a realist and saying, take out your bias and watch price action. That's what I do for my clients. Pay attention to how the price responds to the move. So despite a bullish midterm move, we do see some levels that I'm currently not in love with. The VIX, the fear index is in the low 12s. We've been here for a while. It doesn't mean we can't go higher. Put call ratios in the 40s. Inflation is at the highest level since October 2018. If that period does not ring a bell, that's where we saw a 20% dip. Completely different time. Don't think we're going to see that, but it is a real stat. And we are in the high 80 percentile range of S&P 500 stocks above their 200-day moving average. Highest since September 2014. Does this mean the world is ending? No. I'm simply stating many of the laggards in the risk-off areas, sectors, and the Russell 2000 finally did play a little catch-up, and I'll show this in the results. So I'm a little concerned where people are going to turn to next. And so we are overbought short-term. That does not mean we are overvalued. If we compare these to overvalued levels like bubbles and so on in the past, we're 20% off those valuations. So don't necessarily view that as too much of a concern. There are always opportunities, but I continue to question the real risk reward here. We are currently trimming as we go higher. Love the move higher, but I believe we will have a great year, but I want to see earnings, if earnings can pull their weight. For now, the 10-day moving average continues to hold. Institutions buy that At least recently, anytime we see a dip, even when we bombed Iran overnight and they were, the whole issue overnight that was occurring, we did hold those levels. So understand that after huge rallies such as this, it is not uncommon to see 3 to 10% dips. I don't know when it's going to happen, but I'm going to be a realist and take some gains here. This could easily happen. So the summary, watch price action and see how we're going to turn out here. So in short, we're testing ranges, we are breaking out, and this is good price action right now. So we'd have about 65% still invested and slowly taking gains. Understand that we had a lot in higher risk areas. So that is why we feel the need to take some off, and because the performance has been really, really good. So do we think the move is going to go higher? Let's take a look at some charts and we will go from there. So here is the market summary, the major indexes. This is, again, as of basically 254. I'm going to update this so you can see it. It's, again, not the close yet. So it'll be interesting to see how the day closes to see if we sell off a little bit or not. But overall, so it's a fantastic week. As you can see, this is the weekly performance. The recent laggers in the Russell 2000 and the Dow are playing a little bit of catch up. The NASDAQ is still absolutely killing all these indexes performance wise. We have a lot in tech. We love it. Let's shift over to the sector performance, and we'll get into the 2-minute drill. Sector performance, let me update that real quick. As of 255, utilities and real estate and technology, the 3 leading areas, we did over the past 2 weeks say, hey, these have been the laggards. Let's see if they play a little catch up, and they have very strong moves. So like I've been saying, the laggards are starting to play a little catch up here. I'm starting to say, where's the opportunity? There are always opportunities, but I question their risk reward. So these are 3 areas that I'm heavily weighted in. Love it. Can't complain there. So now we're going to transition to the 2-minute drill. 2-minute drill starts now. So we're going to start with current levels. This is the S&P 500, the major index that we track. What you're seeing here, a couple weeks ago, we tested the 10-day moving average. This is when all the crap was happening overnight with Iran. We would test the 3214 level. We did it 5 times, maybe even 6 because of overnight, if you include that. We bounced higher every time. That is an impressive hold there. We broke out of that range. We tested this range for a little bit, broke out again. We are at, it's called out of the cloud, which is like this gray bluish area. We're out of that. That's a little concerning. I love it, but that's a little overbought. And as you can see, anything over 70, we can remain here. This has been proven. And I said this could happen. We're in a good environment where this could happen. So keep that in mind. But could we test it as high as 3380? Very possible from a technical standpoint, but on the way ups, I will be trimming. So keep that in mind. I want to move to the next chart. This is the chart we've been showing over and over again. After years of a 1.5 year consolidation period, it tends to lead to a breakout. We're currently around like 13-14%. Historically, these ranges have been 37, 55, 56. I mean, this is not surprising, but I do think that the move is a little too steep for me. I like the backdrop. I think it's going to go higher midterm, but this is quite a little bit extended in my view. It could go higher. Again, that's why I'm not putting everything in cash at this point. So next chart, put call ratio, something to pay attention to. Again, the put call ratio, if you don't know what that is basically are people shorting, are people buying insurance to protect their portfolios. When I see not much in the way of, caution, some people call this complacency. When I see anything below 50, it's like, we tend to see these levels, and we see a spike in the VIX usually, which is the fear index, and the S&P 500 goes down. But we've proven recently we can remain here, so it doesn't necessarily mean anything. It's just something to pay attention to, that historically when we hit these rates, we tend to see a little bit of a pullback. May never happen. And finally, the VIX, the fear index. We've talked about these ranges, basically 16.5 to 14. The market tends to do well when the VIX fear index is in that level. We are currently below that, which makes me, this is a little bit of, we need to take a little bit of caution here. There's a little complacency in the market, but it can remain here. But we tend to historically see some nice bounces in the VIX when we're here. So again, usually when you see the VIX at like the 35 level, there's too much complacency. Again, these are not for sure sell indicators whatsoever. They're just something to pay attention to. So again, in summary, we like what we're seeing here. This does not surprise us. There's a lot of things working here to make the market go up, but we are trimming here and taking gains. So thank you for your trust. Let us know if you have questions along the way. We hope these are helpful. Make sure you pay attention to the emails that we send you clients. We recently sent an email referencing tax reporting. If you do not have a traditional IRA that is in required minimum distributions, you have not taken a distribution, you don't really, if you have an individual account, you'll have to pay attention to that. If you have a joint account, you'll have to pay attention to that. But many of the younger clients that don't have a joint account or an individual account don't even have to pay attention to that. It's just how things will be reported. And so don't be expecting the tax reporting to be coming to you until later on, because we do have some real estate investment trusts, which could be the latter part of February. So just want to give you that expectation. But thanks again for your trust. Let us know if you have any topics, anything you want to discuss. But again, our goal is to be a realist through all this. Okay? We love the move higher. We were a part of the move higher, but we also want to be a realist and say these moves tend to lead to a little bit of a dip. So that's where we stand. Thanks again for your trust. Have a great rest of the day and weekend. Monday, remember the market is not open. I will take full advantage of that day. Thankful for that day, to be honest. So thanks again.